Hi and welcome to my YouTube channel. I'm Shaz Nawaz, and in this video I'm going to share with you the top mistakes property investors make in terms of tax and how to avoid them. So pay good attention. The number one tax mistake property investors make is inadequate record keeping. And I know some people find it boring or they lose receipts, but proper record keeping is essential for accurately calculating your taxable income and expenditure. And here are the steps to avoid this mistake. Keep detailed records of all your income and expenditure which relates to your property business. This includes rent, mortgage costs, property management fees, repairs, maintenance, insurance, car costs, admin costs, any other overhead bills, everything you have to keep. And I suggest you should hire a professional accountant and a bookkeeper, depending on the size of your business, who can help you organize your business and share with you exactly what you need to keep and how long you need to keep it for. This will make it easier once you understand the process to track your income and expenditure and ensure that you are compliant for tax and regulatory reasons. And be aware of the allowable deductions for rental purposes such as mortgage interest, property management fees, repairs, maintenance, so on and so forth. Claiming all deductible expenditure is important because it's going to reduce the amount of tax you pay, whether personally or whether through a corporate wrapper like a limited company. And please make sure you meet all tax filing deadlines and you pay your tax on time, otherwise you can face penalties and interest charges. When you're looking to structure a particular property deal, I think it's crucial to consider the tax implications and the vehicle that you use. And here are some of the considerations that I think you ought to think about. Number one is property ownership structure. Decide whether it's best for you to invest as an individual, a partnership, limited company, limited liability partnership, or a mixed partnership. And each can be used in a tax efficient manner depending on the type of business deal that you're doing and how it's going to be structured. So look at all the implications and then decide which one's best for you. Capital gains tax purposes, CGT. Understanding the CGT, capital gains tax implications when buying or selling a property is important. Also be aware of your principal primary residence relief. This is when you own a property, you live in it in entirety, then you sell it, you don't pay any tax. Stamp duty land tax is important as well. Calculate SDLT based on the value of the property and the applicable rates. And remember, SDLT is very complicated, most people don't understand it, and there are certain exemptions and reliefs that apply. It's a minefield, but there's lots of opportunity in SDLT if done properly. Mortgage interest relief, if you own it through if you own property in a limited company, you can claim the whole lot. If it's in your own name and you become a high rate taxpayer, you can only deduct a 20% tax credit, so be aware of that. And then it may be the case you own some property personally and you want to incorporate. Look at the pros and cons of incorporating and the tax consequences thereafter. Now that I've covered the biggest mistake, let's look at some of the tax breaks for landlords. Wear and tear doesn't apply anymore. Wear and tear used to apply where you could deduct 10% of the rent. That disappeared, and now you've got a replacement allowance, so be aware of that and see how it works. Number two, rent a room relief. If you rent a room in your main residence, you'll qualify for rent a room relief where you can earn up to £7,500 tax free in any 1 year. If two people own the property together, let's say husband and wife situation, then you get £3,750 each. Business asset disposal relief, previously known as entrepreneur's relief. If you meet the criteria and you qualify because you have a trading business, then you pay capital gains tax on the first £1 million in your lifetime at 10%, and that is a very low rate of tax in terms of CGT. Rollover relief, again, if you qualify, this may apply to you where you sell a business and then you redeploy or reinvest those funds into another qualifying business, then you can defer your CGT. And again, this is for trading businesses and not investment businesses. Research and development, R&D tax credits. If you're a property developer and you're involved in any kind of enhancement, innovation, improvement in technology in a particular sector, then you may qualify for R&D tax credits. it's a very good incentive, so do look at it. Incorporation relief, if you're selling or transferring your business from a single entity or a partnership into a limited company, you may qualify for incorporation relief, which means you don't pay any CGT on incorporation, but you have a change in the actual base cost when you move to a limited company, and you defer the tax for the time being. Something else to think about is, can you benefit from capital allowances? Capital allowances in a nutshell allow you to deduct the cost of certain capital expenditure, i.e. fixtures and fittings, plant and machinery, equipment, etc., against your taxable income. To benefit from capital allowances, you have to have a trading business or you have to have serviced accommodation. Investment properties are like buy-to-let properties, do not qualify for capital allowances. And whenever you're buying a property, especially commercial property, speak to a tax specialist who can assist you with looking at whether you can negotiate capital allowances with the seller. That's quite important, and a lot of people miss out on that. With capital allowances, if you've spent money in the year which qualify for capital allowances, then make sure you look at the annual investment allowance. At the moment, you can claim £1 million in any 1 year, where you accelerate your capital allowances and see how you can benefit from that. Now, if you're buying a property below the SDLT threshold, then guess what? You pay no stamp duty land tax. At the moment, on residential properties, that's £250,000 or less. At the moment, for residential properties, that's any property that's less than £250,000. And keep in mind that there's different thresholds for SDLT, so the more expensive the property, the more SDLT you pay on that portion of the price. If you're buying 2 or more properties, you may qualify for multiple dwellings relief, where you work out the average of the price of the 2 properties, and that may reduce your stamp duty land tax. There are many other SDLT reliefs. If you're rescuing a broken chain, you can save on SDLT. If you're exchanging your house for a new house with a developer, savings in SDLT. If you're a property trader and you're buying from probate, there's savings on SDLT. If you bought a property which is uninhabitable, again savings in SDLT. If you're buying 6 or more properties in one go, you can pay the standard rate of SDLT. You can use multiple dwellings relief, or you can pay the non-residential rates. You have to work out which one gives you the best outcome, and you can use that one there. There are many other SDLT reliefs which I'll cover on a different video. Any questions? Comments below. If you find the video useful, click like, hit subscribe so you can be updated with all the new videos, and I'll see you next time.